Hey everyone. So I want to talk about how much you stand to lose if you don't lose stop losses. Now, this was an important question somebody asked me on TikTok, um, and I think it will illustrate how risky and how volatile these penny stocks can be, and why it is important to cut your losses. A lot of the times, I'll look at a 3-month chart for a stock to gauge its trading range. These are just estimations, right? So if I see that a stock generally goes up 30 or 40 cents, but it also generally goes down 20 cents, I can get an idea of where the stock maybe might go. Eventually, right, it'll break out of its trading range and it'll go higher or it'll go lower, but then it'll establish new trading ranges at a higher or lower price. But if I'm day trading, I want to have some sort of indication of how much I stand to make or what I stand to potentially lose. In other words, where I should get out. If the stock goes down 20 cents, generally speaking, but then it goes up 40 cents the next day, I might not want to get out of that position, right? I'll say if it goes down 30 cents, that's when I'll get out, because I know that it can move around 20 cents. So I don't want to get stopped out prematurely and then have it go up the next day. I like to get an idea of where it's going. That's why we use stop losses. But this guy's question on TikTok was interesting, and he said, show us what happens if we don't use stop losses, how much we stand to really truly lose if we are not smart, if someone's not smart and doesn't get out. So I want to use this stock as an example. It's very risky. I'm not a licensed broker, financial advisor. I'm not recommending you buy any of the stocks that I ever talk about, especially these. These kind of stocks are pump and dump stocks. People promote them on their page. They sell courses, they sell membership, access to themselves. They buy this stock on Monday, and then a week later they say, hey, this looks interesting, you should buy it. Their subscribers buy it. Their subscribers go on social media and promote it. What do you know about this? What do you know about that? And they drive up the price even more. At some point, the pump and dump guy who bought it a week ago is selling it for humongous profits, leaving the rest of us holding the bag going, what happened? So it's important when you don't have a stock that has an established trading range to get in, get out, and who cares if it keeps going higher, because the likelihood that it's just going to be a runaway train forever is very unlikely. And I know a lot of new traders think, well, it went from 2 to 11, so I'll buy it at 11 and it'll go to 20 because look at how it behaved the last couple days. Very unlikely. Doesn't mean that it's not possible, but it means that it's unlikely. And if you buy something, so I want to walk you through. I was going to do it on the dry erase board, but everything is backwards. So I'll take a picture and I'll put it on somewhere in the video so you can refer to all of the examples. So example number 1, I'll just hold it up here anyway, is the guy buys Genius Brand, buy, sell, and profit. He buys Genius Brands. He buys 1,000 shares at $2 and, what did I say, 30 cents. The next day, so here it is. He buys it here at around, my math is going to be off. Okay, well, let's just say here. He buys it here at 2.30. Well, even though it says 2.33, we'll just pretend because whatever. He buys it at 2.33. The very next day, it shoots up to 4 and 5 cents. But he sells it at 4. So he buys it and sells it almost at the high of the next day. And he makes $1,700. That's fantastic. But in the next example, over here, he sees that this stock has done extremely well. It is now $8 a share, right? Over here, the very next day, it hits $8, and he goes, shit, I made a mistake over here. I shouldn't have sold it. Boy, am I an idiot. So he buys it back at $8. He buys the 1,000 shares. So he makes a $8,000 investment. Now, the very next day, it hits $11.73. And this guy is sitting there going, oh man, this stock is going to go to 20 and I'm going to make so much money. Because if it went from 2 to 11, naturally, that's the pattern, and it's going to go from 11 to 20. And I'm going to make a boatload of money. Problem is, it starts dropping. Now, I happened to be watching this stock that day, and it dropped all the way from 11.73 to 4.25 before rebounding in the afternoon and closing up at 6.86. But our friend here bought it at 8. It went up to 11, and he didn't sell because he was being greedy. And now it's at $6 a share, which puts his loss at pretty significant loss. Now, if you look at the stock today, this guy, by the way, has held. Right? He bought it at the high, he bought it at 8, and he's held. And you can see right over there, it's $3.89 today as I'm filming this video. which puts his loss at $4,000. That sucks. That's why you get out of bad trades, or risky trades, or volatile trades, like pump and dumps, like this one. If this guy had purchased it at 8 and sold at 11.73 or even 11.50 or even 9, he would have made a decent amount of money. And as it started to drop, what he should have done was said, oh man, I bought it at 8, now it's 7.50 or 7.80 or whatever, I'm going to cut my losses and get out. But he didn't. This is when you hear people say stock trading will wreck you. These are the examples of how it will wreck you. He bought it at 8. It's $3.89 today. His loss is $4,000. He's wiped out. If he had $8,000 to trade and he put it all in this one stock because he thought it was going to make him rich because some people on Facebook were talking about it, that's his loss. He's not left with very much money after that. And he can't make any new trades because he didn't get out in time. And he's not going to admit it. He's not going to take a $4,000 loss. So he's going to hold his position and not be able to make any other trades. And that's why it's important to get out of a position that's dropping, especially if you have limited funds. Because now this guy can't make any other trades. He's blown his one shot. Now, let's look at the very last scenario. The guy who buys at $11.73. The guy who buys 1,000 shares because he thinks it's going to go to 20 because it was 2 yesterday or it was 2 3 days ago and now it's 11, so naturally it's going to go to 20. Someone buys at the very top of this rally at 11.73. And that guy also does not cut his losses as it drops because he wants to believe. It's magical thinking. He wants to believe his stock will come back. But it doesn't. It drops. It goes all the way to where it is today, $3.89, which puts his loss at $7,840. Let that sink in. When people say you shouldn't trade stocks because it's risky, these are the people they are talking about. These are the people they're talking about. If you want to buy a stock at the record high after a massive rally like that, I would say probably don't do it. But I would also say, if you do, cut your losses and get out if it starts to drop. Because this is what happens when you don't use stop losses. So your loss could be 2%, 3%, 5%, 8%, 10%. Right? Day traders usually use a stop loss anywhere between 3 and 10%. So you stand to lose that if you are smart and not being greedy and not chasing a stock. Right? The guy who bought it at 2, this guy, what he should have done was just sit out. Because you don't know where it's going to go. He didn't know it was going to go to 11. He didn't know it was going to go to 8. He bought it at 2. He doubled his money. He should have said, hey, I made a trade. I got lucky. Good for me. I'm done with this. I'm not chasing a stock that is out of control. But he did. And that's his loss. Because he was being greedy and not smart. And this guy was also being greedy, foolish, and not smart. This guy was chasing something that had had a massive run-up over the last 3 days. Naturally, there's going to be profit taking. Of course there would. Let's say you bought this shit at $2 a share a week earlier, just on a whim, and it went up to 11. You wouldn't be taking some profit? Of course you would. That's the smart move. Oh, but what if it goes to 20? What if it goes... Well, it might, but it might drop. Let's say you bought it at 2, you held it at 11, and it's $3.89 now. I bet you're kicking yourself. So it's important on both sides to take your profits when you got them and to take your losses before they get out of control. So I hope this video illustrates the difference between the smart traders who get out before something tanks and the dumb traders or the new traders who just frankly don't know enough yet. So now you know. If you're a new trader, you're not dumb. You just don't know any better. But now hopefully you do. When you get into one of these very risky stocks, and generally speaking, anything under $5 is considered high risk. It's a penny stock. Take your profits. Be happy you got them. Don't chase. And if you do chase, have a stop loss. protect yourself, protect your capital. Because if you have $11,000 and that's all you have to trade with, or you have $8,000 and that's all you have to trade with, and you don't get out of a stock, your money's tied up. You can't make any more trades. You're done. You're done. So I hope you learned something. I hope you thought this video was helpful. Please like it. Please subscribe to it. If you follow me on TikTok and all that stuff, that would be cool too. Links are in the bottom below. And thanks for watching, and have a